This is part 3 for chapter 10, and now we're going to look at retained earnings and dividends. Now, retained earnings equals our cumulative net income minus any losses minus any dividends. If it has a credit balance, it means our earnings have exceeded any losses or dividends, and if it has a debit balance or deficit, it means our earnings have been less than what we've had losses in the past and any dividends we've paid out. Now, again, it equals the cumulative net income minus any losses or dividends declared. It's accumulated earnings the company keeps, not a reservoir for cash, normally has a credit balance, but it can have a deficit. A lot of times you'll see this in startup ventures. Now, we have 3 ways of rewarding stockholders. We can do it via cash dividends, stock dividends, or non-cash assets. So that's what we're not going to cover that. We're going to focus on cash and stock. Now, a company must have both enough retained earnings to declare the dividend, enough cash to pay the dividend, and the board of the directors is the only one that has the authority to declare a dividend. Company is not obligated to pay dividends until declared, and then it becomes a legal liability. And when we look at dividends, we look at 3 dates. Because this all doesn't happen at the same time, we first have the date of declaration. That's when you establish the liability. Then they come up with a date of record. And what the date of record is, it says, because stock is bought and sold all the time, whoever owns the stock on that date, at that second, they're going to get the dividend, even if they don't even have the stock anymore. And then we show the actual distribution of the dividend. So again, remember, retained earnings, we start with a beginning balance, net income minus dividends to get the ending balance, and that's what appears on your balance sheet. Now let's take a look at an example. Jones Company has $1 par common stock with authorized of $200,000. They issued $100,000, and they have outstanding of $75,000, which means they've got treasury stock of $25,000. They declare a 50-cent cash dividend. Date of declaration is, we're going to take it times the outstanding, 50 cents, and the balance is going to go to dividends payable. And remember, we only normally pay on outstanding. Pay cash dividend when it actually goes out. So those are the journals. Now let's take a look at preferred stock. Preferred, they're paid dividends before common stockholders. It's stated as a percentage or a dollar amount on the stock. It may be cumulative, which means that they have to pay every year. If they don't, when they finally do pay a dividend, they're going to have to catch up for all the years they haven't paid. Non-cumulative means they don't have to do that. They only have to pay the current year. So here's our example. We have a company with 100,000 shares of common and preferred stock outstanding. They have $25 preferred stock with 5% dividend, and they declared a $75,000 cash dividend. The preferred is cumulative and has not been paid dividends for the previous 2 years. What dividend would be paid? Well, first we got to take care of the preferred stock. So $25 times 5 cents gives us $1.25 a share times 10,000 for 2 years. And then we have to, remember, you have to always add in the current year. So that means of the total, $37,500 will go to the preferred, and the difference of $37,500 will go to the common stockholders. So the dividend per share for the preferred only for this year is $3.75, and it's 37.5 cents for the common. Now, what happens if it hadn't been cumulative? Well, then all the preferred stock would get would be the 1 year, $12,500, and the difference would all go to the common stockholders. Now, stock dividends. Proportional distribution of stock to shareholders increases stock account and decreases retained earnings, but total equity doesn't change. The reason is they want to continue to give dividends, but they don't want to pay out cash, or they want to reduce the average share in the open market. So a company has 100,000 authorized, 50,000 issued and outstanding. They have a 10% stock dividend. So we're going to take 10% times 50,000, which gets us 5,000 shares times 15. And the par, 5,000. So that gives us our journal entry. So we're going to take it out of retained earnings and take it to common stock and paid-in capital, which means it has zero effect on total equity because we're just moving it around. Stock splits, they increase in share. It causes an increase in a share with a proportional reduction in par value. It decreases the market price per share. Now, they used to do this a lot because people didn't want their average price to go up too high, but now it seems that people are leaving it alone because they want to show how much the value of their stock has grown. Has no effect on account. And now what I'm going to do is walk you through what this looks like. So here's our company. They have $100,000 issued and outstanding with $2 par. And we're going to look at what's the effect of a cash dividend, a stock dividend, and a 2-for-1 stock dividend. All right, so what is the journal for the $200,000 cash dividend? Well, what we're going to do is take the money out of retained earnings, and we're going to set up a liability, which means this is going to have an effect on total equity. What if we have the 10% stock? So retained earnings is going to go down by $200,000, but then we're just going to redistribute it to common stock and additional paid-in capital. Now, what is the journal for the 2-for-1 stock split? There is no journal, but shares double, but par is reduced to $1. So now let's actually look at what it looks like on the equity section of the balance sheet. So here's what we look like. So first, what's the effect of a cash dividend? Well, our retained earnings is going to be reduced and total equity is reduced. So retained earnings is going to go down by $200,000 and total equity goes down by $200,000. What's the effect for the stock dividend? Well, what's going to happen is shares are going to go up. Retained earnings is going to go down by $200,000. Our common stock is going to go up by $20,000, which is $2 times the 10,000 shares. Additional paid-in capital is going to go up for the difference. So our total paid-in capital will go up to $1.4 million. But if you notice, our total equity, total shareholders' equity does not change. Now, what's the effect of a 2-for-1 stock split? Well, the authorized is going to double and the par is going to go in half, but total equity does not change. So I hope that helps you see that. Now, one more. Let's look at the effects on total. If we issue stock, we're going to increase assets. Why? Because we're going to get cash. There's no liability, but also stockholders' equity goes up because we have more shares of stock. When we purchase treasury stock, we're going to decrease our cash and we're going to decrease stockholders' equity because treasury stock is a contra account. When we sell it, we're going to increase our cash and increase our stockholders' equity because we're going to have more stock outstanding. Declaration of a cash dividend increases liability until it's paid, then it decreases it, and it decreases stockholders' equity when it's declared. Stock dividends has no effect, and neither does stock split on total equity. And that ends this chapter.